Okay, so I'll start. Just a quick overview. What I'm going to go over is, first I'm going to explain how this coronavirus that we all know now caused a health crisis around the world, and how that health crisis evolved into a financial crisis, as you see here. And then I'm going to go over the environment, or the environment in the U.S. that cultivated, or that made it possible for the coronavirus to cause such a devastating economic impact. Because it's not the disease itself. There are many other factors that contributed to making the U.S. vulnerable right now. So that's the second part that you'll see. This I'm probably not gonna have time to go over today, but that's one of the last slides. You can see what I think. You can see a comparison of what the government's doing as of yet, in comparison to what I think needs to be done. And at the end, I'm not going to cut. This is probably the most important part, is my portfolio recommendations in the long term. I want to help you guys get a picture of when the bottom of this whole crash is, and when you can what you can start to buy at the bottom. Because right now you can't really argue for any particular stock or anything, just because there's so much panic. Just some quick numbers. These are out of date. It's more over 300,000 now, but as of March 18th, so this was just last week, there was 200,000 infections globally. I think now it's 300,000, something like that, 320,000. The S&P 500 dropped. Now it's over 30%, but again, at this date, it was over 30%. So those are kind of the big things. There's a big virus. A lot of people are infected. It's spreading quick, and financial markets are crashing. Now I'll do a little blend of an economics lesson. So here you can kind of see there's something called the business cycle, which is pretty much this. This is one cycle of the business cycle, and just like any cycle, it repeats itself. And this cycle it's also called the debt cycle because of how debt can cause an expansion, which is asset values are going up, and also cause a contraction that repeats itself. See how it starts to go back up and then continues now up until now. So the reason why it's also called the debt cycle is because early on, again, so interest rates follow this green line. Early on, when interest rates are low, credit is really easy for companies to invest. It's relatively cheap. So a lot of debt creation is made. And at the beginning, it actually increases revenues in a way that they're still able to pay off the debt. But as asset prices rise and people get more optimistic, eventually what happens is debt levels increase faster than revenues, and the ability for the economy to pay off the debts. This can happen in the housing sector, which is what happened in 2008. And just so I should mention, this is 2008, the 2008 crisis, and this is now. So I'm doing a comparison so you can kind of see the similarities and also the differences, which I'll point out. So when debts start to increase faster than revenues, there's a vulnerability because companies' abilities to pay off the debts that they were raising, the debts become out of their means, and there's vulnerability, and it's all based off of prices continuing to rise rather than their actual ability to pay off the credit. So usually what happens as things get risky, the central bank raises interest rates to slow down bad lending, which kind of pops this bubble and creates a downward cycle where assets go down. One thing I'll notice, just to get rid of the red, one thing I'll point out here, I call this slide pushing on a string, and you'll see why in a second. So one difference between 2008 and now is this purple line. See here, the purple line is Fed assets. So here, the Federal Reserve assets were relatively low, and then they spiked up high after the 2008 crisis to stimulate the economy and by printing money. But Fed assets, when they go high, just think of it for now as the amount of stimulus that's being made. I won't go into the details. So they're not really stimulating because the economy is well. Then to get us out of the situation, they do a lot of stimulus called quantitative easing, printing money, and all sorts of things. Now, going into here, you see that the continuation of that after 2008. There's the Federal Reserve kept on printing assets, printing money, and continuing with quantitative easing, even before the bottom of the business cycle. So here it was in response to the crisis. Here it was happening well before. Because this was already used, the economy, you can think of it as we became kind of like spoiled children. When your parents keep saying yes to every toy you want, eventually when they say no, it means a lot more to you than if they hadn't always been saying yes, and vice versa. So here you can think of the economy as we were spoiled, and finally when they say no to the toys or they decrease their when the economy starts going down, even though the levels of the federal assets and their stimulus is very high, it doesn't mean much to us because we had it. It doesn't mean much to the U.S. because we had it for so long. And this is called pushing on a string. This is just a kind of a geeky term you can learn. It's termed pushing on a string because you can think of it as there isn't any, the Federal Reserve doesn't have any more leverage on the economy. They're printing money and they dropped interest rates to zero. But as you can see in this news headline, even though they were stimulating, the financial markets were still going down and the economy wasn't responding.
Chris, I have a question.
Yeah.
Actually, Tony had a question first. If you look at the Zoom chat.
Okay. I'm actually going to save questions for the end. So if you can
gotcha.
Done, just because there's so much I want to try and go over.
Okay.
Yeah. I only have, I'll push it for 10 more minutes. And then if anybody wants to stay late, they can ask questions. That's what I'll do. But I got to get everything. So here, investor sentiment. This is called the Economic Surprise Index. And this is over the course of 2020 and 2008. So I'll just write that quick. 2008 and 2020. That's the time frame in case you can't see it. So pretty much how this works, I'm going to simplify it. So Bloomberg gets, if this line represents what economists estimate for the economy, and this line represents the actual numbers that come out. If the actual numbers end up being better than what economists estimate, then there's a positive surprise. If they end up being below, then there's a negative surprise and it's colored red. And if it's positive, it's colored green. So usually, as you can see here, when there's a negative surprise or when estimates are above what actually happens, there's a negative shock that corresponds with a decrease in the S&P or the value of the stock market. As you can see, that's what this orange line is. So that's usually what happens, and that makes sense. If things are worse than we expect, then we pull out of our investments. That's rational. Here, you notice going into 2019, the S&P 500 grew while the fundamentals or the state of the economy was actually worse than expected. Here you can see some irrationality, and this is typical of late in the business cycle. Remember I was saying how people get too optimistic, and even though their debts are increasing faster than their ability to pay them, they still invest because prices are rising so fast and they want to get rich quick. So that's pretty much what I'm saying here. I'm going to start off going over a brief overview of the consumer, because the US is a consumer-driven economy, it being capitalist. So it depends largely on how much consumption there is. And I'm going to explain real quick two concepts. There's the wealth effect and the income effect, and a deflationary cycle. So the wealth effect, the reason we monitor home values, which is, see, it's this orange line, we monitor home values because if home values are going down, what happens to consumers? If they see their homes are decreasing in value, they're going to feel poor, and when you feel poor, you spend less because you feel like you have to increase your saving. But fortunately, the consumer in the U.S. actually looked like it was doing pretty well going into 2020. Again, most of these charts, you don't see the dates. They're 2010 to 2020. That's the time range. So home prices were increasing, yet this blue line, which is the savings rate, and that's the savings rate is the proportion of income that consumers are saving and not spending. The rest of it is what they're spending. So if the savings rate is going up, that means that consumers are spending less and demand is decreasing. So this is important to notice going into again, this is part of the environment that made way for the financial crisis. So demand was decreasing. That's what you get out of this. And this is the start of what could be a deflationary cycle. And pretty much what that is, it's a self-reinforcing cycle where, first off, consumers they spend less because they're spending less. Profits for corporations go down, and when corporate profits go down, they can't afford to hire as many people or to have as high salaries. So there's the negative income effect, which is when people are fired, so incomes overall decrease and salaries decrease. And when this multiplies the contraction, because consumers are now they're able to spend even less than before, which again goes back to corporate profits. They go down, and there's a deflationary cycle because less people have money, and then there's less people to bid prices up. So asset prices start to fall, and this is a cycle that feeds itself. Again, you can look at these headlines on your own. I'm going to skip this just for time. You see, so yeah, this is important. So here, again, shoot. So these are debt levels. Green is government debt. This is the corporate debt. And while the household debt looks good, this is actually because up here it was really bad. This is 2008, where there was just so many people taking loans for homes that they couldn't get. So even though relative to this height, this looks good, this is just deleveraging from the 2008 crisis. But really the focus here is corporate debt. That's where things look bad for the US leading into 2020. So notice this slope. I did an estimate, and I wasn't able to get the actual data to get percent change, but this slope, it's roughly, towards the end, it was roughly 5% growth I estimated. While here, GDP is hovering around 2%. If you can see this orange line, this is, oh no, sorry, it's this blue one. this GDP growth is at about 2%, while this slope is very steep, and it's steeper than 2%. So what does that mean? Going back to the business cycle, what I was saying, that a characteristic of the end of the business cycle is that debts are getting higher than income. You can think of GDP as the revenue of the economy. So if the revenue or the income of the economy is growing at a slower rate than the debt or than the debt of the economy, then sorry, I got a notification. If the income is growing at a slower rate than the debt, we're becoming more vulnerable and more leveraged. And that just makes, all we need is something to pop the bubble. And this was happening both for corporate and government debt. So now getting specific into the different types of debt. Here, this is corporate profit growth as a percent. And again, these are comparisons of the two. This is the 2008 period, and this is now. Here you can see the trend is actually downward. The peaks are going downward, which means that incomes for the economy are going down much slower than the increase in the debt levels. I'll go to the same for households. It didn't look as bad. So I'll skip over it because, again, you can read this on your own. I was pretty thoughtful with my writing. So now that we have this idea that debts are the economy's too leveraged, making it vulnerable for when the coronavirus hit and just completely stopped demand and diminished supply. We're going to dig a little bit, really briefly. We're going to dig deep more in detail of the debt. One particular type of debt that was dangerous was high yield. We're in the high yield corporate bond markets, because, as I mentioned here, in 2014 during the shale boom, a lot of loans were made to energy companies that were trying to make it through the price war. And now those oil companies are really strained. The prices are falling while demand is falling, which means usually when prices go down, demand increases, but prices are falling. There's way too much supply, and at the same time, because of the virus, which is just kind of a perfect storm, demand is decreasing at the same time, almost to none, which makes it very vulnerable debt in the high yield bond market. Here you can see a specific example of ExxonMobil in the oil industry. Again, you can look at this on your own, but really quick, here you can see how the probability of default shot straight up, and the price of Exxon crashed. And this is just an analysis of the airline industry was hit too because of travel bans and travel restrictions. And again, you can go through all this on your own. Here, one last thing before I get to my portfolio recommendations, and then I'll accept questions. This is kind of to contextualize my portfolio recommendations. So here you can see that as a result of this crisis, the US dollar became very valuable relative to other currencies, and actually relative to all assets. If you think about it, if $900 just a month ago was able to buy one Tesla share, now $400 and something can buy one Tesla share. So it's not just relative to other currencies that the dollar is decreasing, is increasing in value. It's relative to other currencies too. And I say this for those of you who are interested in currency trading. But what's important to know about this, and I explained, you can look, if you want to learn the economics, some of the economics behind it, you can read this on your own. But I want to argue that the dollar is going to continue to strengthen because, and this is probably one of the most important concepts of this presentation. The first crash that we've faced so far, I think it's a response to the health crisis, but we're not done with it yet because the economic implications haven't started, or they haven't fully. They have started, but they haven't fully developed yet. I think they've just started. Going back to what I was saying about consumers. Shoot, I shouldn't have gone all the way back because that's really far back. But there's that cycle. Right now, jobless claims are estimated to go up to 2 million, and that's just the start. Once that affects corporate profits and has that wealth and income effect I was talking about, it's only going to get worse. And debt, and going back to the vulnerable debt, as companies are compressed, defaults are going to increase and bankruptcies are going to increase. And this is all destruction of money. So even though there's stimulus going on, large stimulus packages, don't be deceived, because that's just a inflationary force. But all of the deflationary forces of debt destruction, bankruptcies, and negative wealth and income effects way outweighs and will continue to outweigh the inflationary forces. So I think we still have a ways for the US dollar to increase in value, and because of that, this is my summary portfolio recommendation. Cash. For right now, I think cash is actually a great investment. And reflation, once asset values start to tick back up, and signs of this will be big, after the impact of some big bankruptcies occur, and once unemployment, or once jobless claims actually start to slow, reflation will start to occur. And once inflation becomes a worry again, people will go to gold to protect them from a devaluing dollar while staying safe. Gold kind of serves both of those purposes. So keep your eye out for a gold rally once we hit the bottom. And soon after that, I think it'll be great to buy stocks, because the US always rebounds. We're very resilient, and yeah.
Good job, Chris. That was really good.
Yeah, thanks. I'll take questions, and please look at this more in detail after, because there's so much that I didn't get to say. But I'll take questions now. If you can just say them, or I'll pull up.
Yeah, pull up the.
Question.
Yeah, go for it.
Yo, thoughts on airline companies in terms of like stocks and shit?
I wouldn't trade airline companies just because of their risk of default. I mean, you can do your two companies. There's so many different strategies of trading.
Yeah.
This is just. I think the two right now, the most vulnerable industries are travel, oil, and energy companies, and tourism.
Yeah.
And if you buy them, if the company goes bankrupt, there's no upward chance for increasing value,
Yeah.
While there's other industries that, like there's some solid banks that, even though there's some companies that are really solid that are definitely going to make it through this, but still decrease in value, like Tesla and Goldman Sachs, JP Morgan. So long term, those are probably better companies, while these other ones, you just don't know which one could go bankrupt.
Chris, can you go back to the airlines stock price slide? And I have a question because it seems like the stock was going down before this coronavirus even happened. I was wondering if you knew anything about that.
Oh, it's probably Boeing, because Boeing had that issue with the plane crash, and where is it? Yeah, Boeing had an issue. There was a plane crash, and then there was also something about like a bad model of plane that they put out
Yeah.
that put people in jeopardy. So that was kind of the start for Boeing. Yeah, that's my guess, but that's not what I came as prepared for this for.
Cool.
Yeah.
I'd also like to add that maybe before these big airline companies go bankrupt, maybe they get absorbed by a bigger company, and that could also save their stock price. That's what makes it a fun risk. It's a super risky investment, especially if it's gone down so much already.
Yeah, and ideally, I think the government's already putting out stimulus packages to support these companies. It all depends on which ones get saved and which one take the fall. Who's going to be the Lehman Brothers and who's going to be the Bear Stearns?
Yeah.
Another question.
Yeah.
What would you say are some indicators that say that the stock market has hit rock bottom?
Yeah, that's actually one of the most important things. So, that I wanted to touch on. I think once big after some big bankruptcy, this is all projection, of course.
Yeah.
But I think it's very, very, very probable that there's going to be some devastating bankruptcies, and I think that's kind of an ending, the sign that the end is near. Once there's big bankruptcies, and then there's a series of shocking stimulus packages. What they're putting out right now is just the start. And once there's response to really shocking news like those bankruptcies, I think we will start to want to research more in depth whether it's the end, because it's going to start off with jobless claims, and that as pressures increase, it's going to end up hitting companies and create that cycle of increasing jobless claims and defaults until there's really big, structurally important companies that need to be bailed out. And we got to see if they do get bailed out, which ones do, which ones don't, and how.
Yeah, good point. And there's a question in the chat as well.
Okay, I haven't figured out how to.
It's on the bottom toolbar.
Yeah, I'm sorry. I'm probably favoring because I still have the share screen. Bottom. Okay, here's the toolbar. Crap. Okay, well, somebody else asked me something while I'm looking for this.
I can read it.
I found the chat. Yeah.
Okay.
Will the world economy contraction rate be worse than 2008? Is crude oil going to recover? So crude oil, let's say a quick thought about that. Because supply is so freaking high right now, they've been in the price war. They've just been ramping up production more and more. Yet nobody's been buying. So there's such a surplus that they're gonna, even after demand increases, they're gonna want to keep. They're gonna have to keep prices low to try and sell off all the surplus that's just sitting there. So I don't think crude oil is likely to recover. But again, anything can happen. There's more that we don't know than we do. And will the contraction be worse than 2008? Again, that's hard to say. This is definitely crisis level. But there's just so many unknowns. I'm personally am fairly pessimistic, but I can't really put a number to that. There's just no way to estimate, and that's really what you need to compare it to 2008.
I actually just saw something on Instagram news that this contraction has already gone faster than the 2008 contraction, like 35% in a month or something like that. That was faster than 2008.
Yeah, faster doesn't necessarily mean worse, but yeah, because the initial issue was more of a health issue rather than there was much more of a structural issue in 2008. Like if you look at the slides, banks are more prepared now. The consumer came into this better and less leverage than before. While in 2008, it was the consumer and the banks were very exposed. So that's one thing that's very different. Yeah.
Question.
Another question?
Yeah.
All right. When would you say it would be good to invest into the entertainment industry? So let's say like Disney, HBO, Netflix, and when would you think would be a good time to find out if we actually should do that?
Right now is characterized by panic. You can't really reason why. Very few stocks can you reason why they would go up because of something that's usually reasonable. Like, okay, people are home, they're going to be watching Netflix, might as well buy Netflix. For most cases, that's just out of the window right now because everything is just fear-based, and this is more a game for people who use technical analysis. And I don't know, just gambling. Yeah, that's my first response. But there are companies that have actually made it, like some companies that are working on health responses to the coronavirus, or Zoom. They've just been going straight up. Mm-hmm. But if you look at Disney, they still dropped, like, I don't remember off the top of my head, something like 50%. So you can't really use that type of reasoning right now. That's most of that's out the window.
Question?
Yeah.
Thoughts on the biotech companies, the companies that develop vaccines and shit like that for the coronavirus?
That's not something that I've looked into as much. Yeah. So sorry. I've done more research on the macro stuff than individual companies. But take a look at it because it makes sense. If the same thing's happening for them as what's happened for Zoom, you look at it. It makes sense.
Chris, my cousin is in biotech right now, and she actually has something to say about stocks and biotech to answer Parker's question. If she could speak for a second.
Yeah.
Oh, really?
Yeah.
So my roommate actually works on the coronavirus vaccine. So Moderna is the company that will probably have the vaccine out first. I invested in that stock, and I've already made I only invested like $150. I've already made like $70 in the last 4 days.
What was it again?
Moderna, right?
It's mRNA is their code.
What is it? What's the code?
mRNA.
All right, word.
But yeah, that company, Novio, is the one that got money from the government. And then, if you wanted to, I would invest in companies that sell masks and other protective equipment and stuff like that. But Moderna's the one you're gonna see is most likely to have the vaccine out first, and then once. And the thing is, right now they're still lower than they were in January. So, and that's when they started on they started on the vaccine, but they've also gone down because of this. So I'm assuming afterwards, with the vaccine and then also with the market, I would say leveling out more, they'll be up. I don't know what percentage, but I definitely think it's a good investment. And my friend who works at Moderna, her parents have already made, I think, over 10 grand in their investment.
Wow.
And I think they invested $2,000 and made 10 grand. So.
Oh shit.
Yeah.
Yeah.
Moderna is the one to invest in. That's my thing.
Thank you. That was really good.
Thank you.
Thank you.
Any other questions? And again, I'd prefer if there was more macro focused rather than companies.
Yeah, Chris, you got another question. The first question was from Tony. He said, wouldn't heightened prices enable a company to better pay off their debts, e.g. inflation, ?
Would it higher?
You can look at the chat. It's just a little bit higher up in the chat.
Okay, yeah. I'll have to scroll up. Wouldn't heightened prices enable a company to better pay off their debts? Well, I think there's more nuance to that. I can't just blatantly say yes, but I guess if the company's increasing in value, then but that's not really happening right now. So I'm not sure if that's related to these times, but yeah, I could see how it could contribute to it, but I think there's a lot more that goes on in many more variables that come into play. Yeah, sorry if that's kind of a hand wave answer, but
and I don't know much.
Yeah,
I was gonna say
finance.
Sorry. Just because the equity value of the stock goes up, is that what it's talking about? Prices? That doesn't mean that they maybe have more cash.
Yeah, it can help them. I mean, if they did stock buybacks and then their price increased and then they sold them, that's a way for them to generate more cash. But that's just not happening right now overall. Hopefully that answers your question.
Yeah. I also had another question though. Like, so you mentioned somewhere that the U.S. currency will sort of
yeah,
will have a reflationary cycle at some point because the U.S. currency will weaken. And so sort of on a sort of macroeconomics perspective,
yeah,
exports are more attractive. But since the thing is like, to my sort of understanding so far, it seems like most people will be trying to sell off financial instruments for like maximum liquidity. So like they'll be trying to buy back. They'll be trying to have cash instead. So wouldn't that kind of strengthen the U.S. dollar?
That's what I'm saying. I'm saying right now right now there's a trend for the U.S. dollar to strengthen. The U.S. dollar is strengthening right now as we're becoming relatively cheaper to other countries. I mean, that's less of a factor because demand just doesn't really exist right now. It's more because of deflationary forces. But once demand picks up and people aren't quarantined and there's trade going on, we've become relatively cheaper than we were before, which will increase demand on exports and increase demand for the U.S. dollar. But also the U.S. dollar globally has been viewed as a haven asset. So other countries are trying to sell off their currencies to get into dollars. And that also has increased demand in the Forex market for dollars. And just basic supply and demand. When demand increases, but the supply is the supply is the same. And not saying it's the same right now, but just a simplified scenario. Supply is the same, then the value is increasing.
Okay, yeah.
Did that answer your question? All right, yeah.
Sort of. I think I was just purely looking at it from like a dollar value because I was thinking about the exports, and if the U.S. currency was stronger, then people wouldn't really be looking towards the U.S. for exports, for importing U.S. goods. Yeah.
I'm not sure I understand what you're saying. Could you just try and say it one more time? I'm sorry.
Sorry. It's just the fact that it's the whole like really sort of layman's understanding of economics that when a currency strengthens, people are less likely to buy sort of that country's exports because it's
yeah. So there's definitely going to be a point where the pendulum swings back down. It's the same relationship that if you look at this slide, can you see it?
Yeah.
Yeah. So you can read this but this is pretty much how the relationship works. When right. So far, the U.S. is becoming cheaper as there's been a contraction, it's less because of that. That's just kind of the textbook. That's one of the factors that contributes to the U.S. dollar increasing. But again, it's mostly investors trying to move to haven assets, and the U.S. dollar is one of them. so demand's increase. But like you're saying, eventually what's going to happen is once the US dollar becomes so valuable relative to other countries, it's going to become really expensive. That's what you're saying. It's going to become really expensive, and it's going to swing back down and devalue, and all else equal. So the point of that, the point where it starts to, the pendulum swings back and the dollar devalues because of it being relatively expensive, that I'm arguing that that's not now. I'm arguing that because there's so much more of a contraction left once the deflationary cycle kicks in. I argue that there's still much more. The dollar has much more strengthening left to do before it becomes so expensive that people move away from it. If that makes sense.
Sure. Yeah. Yeah, it makes more sense to me now.
Yeah, I was
Sorry.
just gonna say, I think the magnitude of the safe haven flight just completely dwarfs exports, and that's why things aren't behaving quite that way. But I think it will happen soon.
Yeah, exactly. Yeah, right. And there's exports and imports are so low because there's just no demand right now. Everybody's just in their home, living off of their basement canned goods and, holding their shotguns. I don't know. Yeah.
Yeah, I also wanted to ask on sort of the
And this will be the last question. I'll take, and anybody can message me on Messenger too, if you have more questions. But this will be the last one for now.
Okay, I wanted to ask about sort of like the whole notion of too big to fail firms, because the whole point is like if like I would assume that like investors really shouldn't get too much of a cold feet regarding specific firms in the States because the government has a policy where they thus far try to assist firms that are failing if they feel like they're too institutionally tied.
Yeah.
Things.
So are you bringing up kind of the moral hazard question, whether
whether
they should be bailed out, or whether
I guess in specifically relating here is more so like whether or not investors should get cold feet with therefore investing in things like airline companies, because then it kind of feels like thus far the government will still try to bail them out.
I see what you're saying. So you're okay. Correct me if I'm wrong. You're asking. I was saying earlier to be cautious investing in airlines, but you're pointing out that because they're going to receive support, that they're likely not going to fail. Is that what you're saying?
Right. Yeah.
Yeah, and I mean ultimately that's something we don't know, but because the problems are so large, you're saying, you're making the argument that the government's going to support the structurally important firms in the industry, but historically they do, at least in 2008 they did that, but they weren't able to do it for everybody. If that's why Lehman Brothers failed, and they were definitely a structurally significant bank. They were massive and had major spillover effects, but the government was able to